Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schaefer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are also general partners at Arch Capital, and Arch Capital may have positions in the securities discussed in this podcast. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guests is not formal advice or recommendation. Now please enjoy this episode.
All right, everyone, welcome in. This is the Sunday Deep Dive with Brad Freeman. Brad, how are you doing today? We're in a closet. I think we're seeing you over on your video Zoom. We're in a different location. Yep. How is that? How are you doing today?
I am in my work studio that doubles as a bedroom. So things are going well for me. I'm living a very glamorous life, and I'm happy to be here.
All right, and then we got Ryan here as always too, and we're going to be talking about Wish, which is called Context Logic, but we're going to call it Wish because that's the really what the company is, wish.com, Wish, the mobile app. And Ryan will introduce it, but first we have to talk about potential multi-baggers. Ryan, do you want to introduce the service from our friend Chris at Growth to Value?
Yeah, he is our friend, and basically he's picking stocks that he thinks can 10x in 10 years, and he has one of the best track records out there. Especially from the investors we know. I think C Limited, what was the cost basis on that?
$54 a share, and there's plenty others. The reputation speaks for itself.
But it's a Seeking Alpha service. I'm sure you can find the link.
It's called Potential Multi-Baggers. They run several portfolios there. Chris helps you track what he's adding, kind of what he's seeing out there. It's continuous updates, and the portfolios are all tracked for accountability. It's very important for them, so you can see how the live portfolios are doing. You can see how every pick does in real time.
Yeah, it's not like you're just reading his stuff either. You can kind of collaborate with him, say, what was your thinking behind this, even though he does detailed write-ups and it's communicative.
Yeah, and if this sounds like something that you would want to do or be a part of, you can go to Seeking Alpha and look for From Growth to Value or Potential Multi-Baggers. You'll find it there. You can Google it, or you can go to @FromValue on Twitter. That has all the links as well. All right, Ryan, do you want to introduce Wish.com?
Yeah. I don't know if it's a .com because it's a mobile native e-commerce marketplace, and it's really for cost-conscious consumers. And when I say that, I mean these people are looking. It's like dirt cheap prices. Basically, stupidly cheap. It's similar to Amazon, but just really, really cheap stuff.
Kind of like a garage sale, almost prices.
Yeah, and the supply is sourced from merchants, so it doesn't actually come from Wish, but Wish is basically operating as the platform in the middle. And when I say it's stupid stuff, or say stupid cheap, it's like I saw today a toothpick crossbow for $1.67. So that's kind of some of the stuff that's on there. There's more real stuff, but then there's items like that. And it takes a while to ship. So I think the average time to delivery was 22 days this quarter. I might be getting that wrong. It was actually at 62 days at the height of the pandemic, but that was because of shipping issues. And a lot of the items are sourced in China because that's where they get basically the most competitive prices or cheapest prices. They don't give an exact number on it, but they said the majority. And that's also why the time to delivery is so long because they have to ship that stuff. And then Wish generates revenue by taking, I believe it's still the same, a 15% cut of each sale that's on their core marketplace. So it's not merchant fees, but then they also have merchant services. So there's stuff like Product Boost, which allows merchants to promote their different items. And then they also have logistics services that merchants can pay for. Do you know if that's on do they pay a fee for that? Or is it like a part of the
it's
sale?
Sort of like a fulfillment by Wish. It's kind of like fulfillment by Amazon. I think you subscribe to it. I didn't see any of the pricing rates on there. I assume
it's growing like
you level up. Like there might be tranches that you go through. Like, all right, if you do 1,000 ships a month, it might be this. And then if you do 100,000, it could be a lot more. But that's the fastest growing segment. Yeah.
Yeah. And the company's actually headquartered in San Francisco, but the majority of sales come from Europe.
It was like 46% Europe, 40% North America. So pretty healthy mix. Yeah.
And then a little bit about the history. Fascinating history, actually. So Peter Sholsewski, Anyway, I'm sorry for getting that name wrong. He's a Polish immigrant to Canada. I think that was when he was in his teens, I believe. But he attended Waterloo University, and before he graduated, he interned at Google. He ended up moving down to Silicon Valley, I think in 2003, 2004, and starting at Google. Was an early employee there. Great time to be there. And he eventually moved to Google's South Korean office, where he learned that people sort of, in America, it feels like Google was really trying to have this minimalist page. And in South Korea, people don't mind like crowded search pages with lots of information. And so that's kind of played into Wish's design today. And he actually left in 2009 and spent 2 years on his own writing code and building what was now called, or what was called, context logic. And it was designed to predict interests based on consumers' habits and clicks. Apparently the tech behind it, apparently Peter's a really good coder, I guess. The tech was supposed to be really solid. They got early, it was supposed to be a competitor, an advertising competitor to Google. They got a 1.7 million in seed money. And I think the Yahoo founder was one, he's like, we don't know what it's going to do. We just know the tech's really good, or the Yahoo co-founder. And they even got an acquisition offer from Facebook at one point, but Peter said, no, I want to do this myself. So he called up an old college friend who became his co-founder, and they built Wish, which was the marketplace. And then they went public in December of 2020, and they reached north of a $15 billion valuation following the IPO. And they got funding, a private funding round at like an $11.2 billion valuation. Just before going public. Now it sits at what, $5 billion market cap?
Yeah, I'll get into the numbers, in just a bit, but yeah.
Yeah, so fascinating history, but I'll let Brett dig into the industry.
Yeah, quick one here, e-commerce, everyone knows about it. E-commerce industry is about $4 trillion worldwide. We all know it's huge. We all know it's growing fast and got a giant boost due to the pandemic. It's projected to grow steadily over the next few years, I think, from what I was looking at on Statista. Which isn't the best source, but it's kind of a grouping of sources. It's projected to get to $6 billion by 2025, but remember, those are only projections. And there are a lot of competitors because the industry is so large. So that could include even companies like Amazon, Walmart, or Target. However, the true competitors and the ones that operate in the closest business model to Wish would be someone like eBay, Etsy, Mercari, Poshmark, and then probably increasingly Instagram and Pinterest for the type of stuff, on there as well. Facebook Marketplace, I just thought of that one as well. But yeah, pretty simple industry. I'll kick it over to Brad to talk about more about the management and the ownership.
Yeah, so Peter Soleski, I'm going to go with that pronunciation. And again, sorry if we're butchering it, but he's 39 years old. Ryan went into his background a little bit, but I'll hit on it on a little more personal note. So he talked about in the shareholder letter being this kid from Soviet-controlled Poland and not having access to basic goods and services, and him dreaming of when his uncle would bring him Legos or being able to go to a mall in Western Europe or something like that. So that was his driving motivation behind creating Wish. And I think pairing that with his background at Google and his pretty impressive track record there, I think is a pretty nice complementary resume for this type of endeavor. In terms of more executive experience, that the CFO comes from Jasper Technology. He was also the CFO of Kraft Canada. The general counsel is the former general counsel at Zynga. From an ownership perspective, owners and directors, we still don't have after the offering data. We have before the offering data, but it's usually pretty darn similar. Officers and directors own 70% of the voting power before the offer. Peter himself has 57% of that voting power. The largest 6 funds own about 25% of the voting power. So most of the company's float is spoken for. That's before the offering again. So I'm sure with the billion roughly dollars they raised, that went down, but that just gives you an idea of a baseline of what the ownership looks like.
Right, and they have the dual class share structure, right? Yeah.
Yep.
All right, I'll hit valuation quick. Market cap from when I was looking is about $5.75 billion. Ticker is WISH. Enterprise value is a lot less at about $4 billion. However, I think you can make the argument that you really, as an investor, don't have a claim on that cash. It's a lot different than the company that is generating cash each year, because the way their financials are looking right now, and Ryan will get into it later. I'm sure we're going to discuss it on the second half too. There's going to be a burn for a long time here. So all that cash might be burned. So it's a tough one, whether you want to use enterprise value or market cap, but price to sales is about 2 and price to gross profit is 3.3. So fairly cheap on those two metrics. Unprofitable. So it's kind of hard to look at them on any PE ratio or a trailing 12-month operating cash flow or something like that. But they also have, and this should be noted because it's very important, about 100 million options and RSUs, which would be restricted stock units. They act kind of like they act kind of like stock options. They are ready, I guess, to dilute the share count over the next few years once they get exercised. And to compare that to the current count, the current share count is about 620 million. So fairly strong share dilution coming down the line. Ryan, do you want to hit earnings?
Yeah, Brad, do you have something first?
Yeah, sorry.
So just a question from you. Is that essentially just a shelf offering that they're waiting to file when the time's right?
I think, I'm not exactly sure. I bet it's from just the plans they have with employees. I think they had a founder CEO, one of those level things that are popular now where like there's 10 different levels of whatever metrics they want to use. I could be getting that wrong because I was looking at another company that had that. But yeah, all I looked at was the aggregate share stock options and RSUs outstanding, and it kind of jumped out with Wish, but I don't have the details right now.
Yeah, I missed that. Thank you for bringing that up. I think I missed that in the S1.
Yeah, you got to get to those notes in the. I think it was in the 10K. Those are or the 10Q. You got to get to the notes. It's my favorite part.
Yeah, I mean, although it seems weird for someone with. I mean, Peter's got 57% of the voting power. I don't think you got to power him up with vesting tranches to get him to own a lot of the company. He's not incentivized to do that.
He already owns it, yeah.
But anyway, I'll dig into the earnings. So their first quarter revenue was up 75% year over year. Core marketplace revenue made up the most of it, and it grew at about 40% year over year. But logistics revenue grew by over 300%. So a lot of strength there. And then they are losing money, as Brett mentioned, even though they are really catering towards cost-conscious customers. They don't seem to be too cost conscious themselves. Their net margin was negative 17% for the first quarter. Looks worse last year because there was a lot of IPO related stock-based compensation. They had negative 354 million in free cash flow, but a lot of that was due to the working capital adjustments. There was like a lot of accounts payable. I believe there's a huge increase due to some of the shipping stuff with merchants because a lot of the stuff couldn't get shipped. Like I said, there was a 62-day delay during the height of the pandemic. And so they're just they're coming off that. So cash flow is going to look a little wonky. And then adjusted EBITDA margin was negative 10%. It was negative 30%, I believe, a few years back, according to their conference call. And then sales and marketing spend was 108% of gross profit. So they are they're pouring money into sales and marketing. I think they had a $30 million to sponsor the Lakers.
They are the jersey sponsor of the Lakers. Yeah.
Yeah. So
what do you guys think of that?
They're one of the largest advertisers on Facebook too.
Yeah. What do you think? Lakers sponsorship, good or bad?
Well,
not as a stadium. Shout out SoFi.
Yeah, I'd say the history of stadium sponsorships, the track record is not great, but I hope SoFi doesn't fall in some of those footsteps.
Well, thank you. I appreciate that.
Apparently, the Lakers are pretty big in China, which is a lot of the merchants are. So I guess that was they mentioned that in the reasoning behind it. But I'll get into some of the user numbers. Total monthly active users declined 7% year over year to 101 million. And a lot of that was attributable to decreased advertising spend in emerging markets. And they also de-emphasized the really low-priced items, which is they get more sales from the low-priced items, especially from those emerging market areas, but the economics are terrible on them. Or at least worse. So they said once they kind of have the better logistics in place in those emerging markets, they'll start to ramp up marketing there again. And then revenue per active customer grew 76% year over year. They're trying to target higher lifetime value customers, or at least customers with better economics. And then the percentage of orders above $20 increased 54% year over year. So they're really trying to improve the economics and I guess get higher ticket items. Pay close attention to the wording, though. It says the percentage of orders above $20 increased 54%, not the volume. So as a percentage of the whole, so it could have gone from like 2% to 3%. I don't think it did. but it just felt like a little bit of tricky wording there. And then active buyers decreased 3% to 61 million. That kind of falls in line with the total MAUs. But in general, it was a much larger company than I thought. I believe it's the third largest e-commerce marketplace in North America. So it's weird to think that it's trading at a $5 billion market cap considering that. But they are losing a lot of money, as I mentioned before.
Yeah, it totally makes sense. All right, Brad, do you want to talk balance sheet?
Sure. So the company, this surprised me a little bit, raised a little over $1 billion in their IPO. So kind of just meshing with what Ryan just said, it's a big company, and that was a big offering. They have 1.62 billion total now in cash and equivalents. It doesn't really neatly break down things into long-term debt. So we will go kind of through liability items. So current liabilities are about $1 billion in total liabilities. That's made up of payables, refunds, which they have to do a lot of because the quality's not super great, but we'll touch on that later. And then every other accrued expense that they have. They only have 34 million in non-current liabilities. That's all lease agreements. And they have a brand new $280 million credit revolver. Well, not brand new, but as of November 2020. And they're paying LIBOR plus 1.5% on that. So pretty darn affordable access to credit. Interest expense last quarter was $0. It was a couple million for the whole year of 2020. But as we talked about, they burned through, what was it, 354 million in free cash flow, which I know some of that was not non-cash items, but transitory items that aren't going to repeat. But even with 1.6 billion in total liquidity, that doesn't last. I mean, they have a couple years before they have to raise money with these current unit economics, but hopefully margins will quickly move in the right direction before then.
Yeah, you'd hope that they won't have to raise again. It'll take a few years at this burn rate.
Peter said this before in interviews, and I know Adam Newman said it, but he says we could be profitable if we wanted to right now, but we are spending a lot on marketing because we want to raise awareness and we want to grow. And when they have the burn rate to do it, I guess it kind of makes sense.
Yeah. It looks like they're spending a lot to build out logistics that has pretty bad margins right now. Hopefully that'll improve. But I guess that's something good to talk about in the second half. Let's take a break, and then we'll get back to the show.
This episode is brought to you by Microsoft 365. You know that feeling when you wake up and 5 minutes in, it's like the day is gone and your to-do list is out of control and you just don't know how it got this bad? Yeah, us too. With Outlook in Microsoft 365, you'll get one place for your emails, calendars, and to-do lists. Plus, with Office apps like Word, Excel, and PowerPoint, and 1 terabyte of cloud storage included, you'll be ready to take on whatever life has in store. To learn more, go to amazon.com/Microsoft 365.
Okay, welcome back. Next up, we have anecdotal evidence and customer stories. I think we all probably download the app to check it out on this one.
I haven't purchased anything.
I haven't purchased anything either, but Brad, what are your thoughts? I think it says here you purchased something. So what are your thoughts about Wish?
I was a pretty loyal user in undergrad when I had no money, and I still have very little money, but when I had less money then, and quality wasn't super important to me, and price was by far the most limiting factor. So it definitely served a purpose for me. I bought some clothes, I bought a watch, I bought I think a phone case, and it was all kind of it wasn't the greatest quality, but it served a purpose, and it was cheaper than anything else I could find. So
what were your thoughts on did they do like the promotion things, like throwing out 50% off, like kind of throwing that at your face on that?
Yeah. And then they did. And then once I downloaded Wish, Instagram and Facebook was just an endless list of Wish sponsored ads. So they're definitely hitting the marketing hard, which again meshes well with Ryan talking about the CEO saying they could be profitable right now if they wanted to be. But yeah,
it says they have like 8 million Instagram followers, which, there's some potential there if Instagram Marketplace or whatever they call it takes off, to use that as a place to sell as well.
Those famous TikTokers just started selling their. I know we sound.
Oh, they said that in the letter. It was in the letter, right?
Yeah, but there are some famous TikTokers, and they recently started selling their energy drinks on Wish or whatever and promoting it through there. I mean, they seem attuned to what is sort of the way to reach consumers. And that really is their target demographic, is the people that are buying super cheap stuff and kind of the kids on TikTok.
Yeah. You want to hear yours, Ryan?
Yeah, I looked at some stuff on the app. I downloaded it. One of the things I saw was Beats Studios for $24.
Saw the same thing.
Retail's like $300.
Yeah, those aren't real. I mean, that's kind of the trick here is they're mostly counterfeit stuff.
So it's like just willingly accepted counterfeit stuff. I don't like everyone's on the same page. Like this is just, I mean, whatever, I guess.
The quality might be, you're taking a risk on that quality of the audio there, but we'll see.
Yeah, there were some things that had like verifications, like a check mark. So kind of like maybe like that's the real product, I guess. And then there's also, I mean, you pay a lot of attention to the reviews and sort of the pictures and the comments and stuff like that.
Yeah. Yeah, I guess I downloaded the app too. It felt gimmicky, I guess is kind of what you guys are saying too. You know,
it's like a feature though, not a bug.
Yeah, well, I don't know. It's a bug for me.
You're a minimalist.
I guess. I don't know. I don't like buying stuff, so I don't think I'm the target market here. But I do worry about churn. Just looking at the app, it seems very easy to churn off. Yeah, I think that's just kind of the big concern anecdotally from what I thought. Next up, competitive advantages. Brad, what are your thoughts on Wish? Do they have any competitive advantages?
Yeah, I think so. I'm looking at Ryan's, and mine looks pretty similar to his. So I'm gonna pick a different one. But I think the cost and their ability to source all this merchandise for very low cost. I know there's Mercari and a couple others that are doing similar things, but there's not a lot of others that are doing similar things. Sourcing new merchandise for profitably, according to the CEO, as cheaply as they can do it, I think does serve as a competitive advantage, because there are a lot of people who where price is the primary motivation. It still is for me. Hopefully that won't be true at some point in my life, but yeah, they are serving a large cohort of people who this really is relevant for, I think.
Yeah, I agree.
That makes sense.
And my competitive advantage then would be scale, because they've got more than 100 million monthly active users, and they've got more than 60 million active buyers.
Trailing 12-month. Right?
Trailing 12-month active buyers. And this is a platform where sales are driven by data, reviews, ratings, comments, pictures, stuff like that. You're going to vet any product through that. Because there are so many counterfeits and stuff like that. And so the more users that are on there, the more purchases they have, the better the product gets. And so I guess that's sort of a scale advantage for them.
Yeah, and it's not apples to apples for economic markets and culturally, but a lot of people were comparing it when I was looking up, like, what's Wish? Is there any companies like Wish? People were comparing it to Pinduoduo, which has done phenomenally well in China. I'm not sure they're exactly the same, but I guess, that's never the thing, like, oh, Pinduoduo of US, this is going to be a $100 billion company too. You don't want to do that, but there's a good example of that type of product working out in China. And that's like another market where there was already established players like an eBay through Alibaba kind of, and they got a lot of other stuff. But then there's also the Amazon with JD.com. So there is an example of all these marketplaces winning within China, and maybe Wish can bring that over here. But I'll talk my competitive advantages. I kind of lock in with logistics and advertisements for the merchants. So it can keep people and merchants dependent on the Wish platform. If they're providing the logistics, if you are advertising with them and that's bringing in users to buy your stuff, I don't know if that's a competitive advantage.
I mean, they've got what?
It could be in the future. I don't know.
They've got what, 550,000 merchants?
They have 1 million. They have over 1 million. Yeah. The reliability and how big the merchants are, each merchant is, I'm unsure of, but they have 1 million according to some article from 2018. So yeah, probably even more, a lot more now. Yeah.
Huh. I must have read the wrong number, but yeah.
I think you might have been looking at non-Chinese or something, because they bracketed out. Yeah. They've given out some numbers, but.
Oh. All right. Future growth opportunities. Brad, you want to go first?
Yeah, leaning into those toothpick crossbows that we were talking about. No, I'm just kidding. So from the S1, but I'm going to take a quote from the S1 for my future growth opportunity. So so I'll just say, we continue to evaluate our options for seeking additional licenses in several other jurisdictions to optimize our payment solutions and support the future growth of our business. So it sounds like they're definitely dabbling in fintech land, and I think that could provide a lot of upside in terms of not outsourcing some of these payment capabilities to third parties and just boosting their bottom line further.
Yeah, I mean, every e-commerce company seems to have done this, where they just make the native payment solution, and people are like, oh, whatever, someone's making Etsy payments or whatever they call it, and you kind of roll your eyes because it's a simple thing. Yeah, it's just everyone seems to be doing it, but they do it for a reason, because it helps with your margins overall. So Ryan, what's your future growth opportunity?
I have two. First, I was going to say quality assurance improvements, but it sounds like people don't care. It seems like I think I don't know. Yeah, it's kind of a give and take. It's weird. I'm not exactly sure if they care. So I think like the verification thing was a good idea. I think maybe an AR element, they might have mentioned this actually, like an AR element where you can kind of see the product in, and apply it to reality. But then also Wish Local, they have more than 50,000 partner pickup stores. This really speeds up delivery time. People can go pick it up from that store. It doesn't require any spending on real estate, and it just improves the overall experience. So I think just getting as many local partner stores as you can would be good.
Yeah, it was kind of a quick hack that they made, because they're not going to be able to spend the billions of dollars to, I don't know, like Amazon does, to really get all this stuff going. For 2-day shipping or whatever people are accustomed to these days. So kind of using these brick and mortar stores could really help. But I'll talk about my future growth opportunity. This is the fastest growing segment, like Ryan's saying. It's logistics services. It's growing at really low margins. You can see their total gross margins decreasing pretty fast as logistics revenue ramps up. But I mean, it's growing so quickly that it is gross profit accretive. I think they were growing 56% last quarter. So it's not like they're growing with zero margins. And they also talk about this logistics as a service segment. I'm not sure exactly what it is. And again, that's something you kind of roll your eyes over, because they're just trying to toss that in to hype up shareholders a bit, I think. But something to watch out for. They really seem to be leaning into the logistics stuff. And it's just outsourcing fulfillment to Wish. So it's kind of like fulfillment by Amazon, if you're aware of that. However, Wish does not have its own logistics network like Amazon does. So the margins, it's kind of tough to see how the margins are ever going to get really strong, but we'll see how it works over time. Hopefully they can get some operating leverage if they can scale this business.
All right. Yeah. Highlights, lowlights, Brad?
Yeah, so I'm going back to the personal experience that I've had with the company. The highlight is the value proposition that they're delivering for people who have the desire to buy things like Legos, as the CEO Peter was talking about in the shareholder letter, and can't really afford to pay for the highest quality. So I think yes, the quality of their stuff is not the greatest, but it does serve a very interesting niche, I think, and that kind of feeds into my low light, which is as soon as these consumers get any kind of disposable income and start to get comfortable with their financial situation, I think user churn will be a real issue, because then quality becomes more important and price becomes a little less important. So I'm not sure how forecastable lifetime value of a consumer can be. I'm not sure how reliable retention is going to be. And I think that means they're going to have to just continue sinking their teeth into marketing to drive traffic.
Yeah,
I think the goal is that, I think you're right. That could be a low light. They're going to have to, marketing spend might be perpetual. But hopefully the goal is that people get some sort of income over their life, that they move away from the platform. But this really could capture that more cost-conscious consumer. And I think there'll always be a market there.
People like going to garage sales. So
yeah,
they like going. I mean, you're not going to go there every day, but sometimes you like perusing a garage sale if you're trying to just find a big deal on something and you're not worried about the quality as much.
Yeah. My highlight would be that Jackie Reese's joined as the executive chair recently. And if you're thinking like, who cares? Like, she was on the conference call. She's like a part of the company. She's like integral to it. It's not just like some passive board member. And she's one of the executives that I think I like best pretty much everything she's touched has turned to gold. She was the lead at Square Capital, chairman of Square Financial Services, left. She was even on the board of directors at Alibaba prior to that. She's chairman of the Federal Reserve Bank of San Francisco. And she didn't need to come to Wish. Like, I don't think she was like just looking for a job. I think she finds companies that she likes that are young and helps them grow. And she's gotten good at that. And she was able to do that with Square. And she's now done it or looking to do it with Wish. And I think it could definitely be a profitable business if they peel back some of that sales and marketing. Definitely could. There's not going to be any huge margins on it, but at 10% margins, the price doesn't seem too crazy. My lowlights would be the deals on the website look too good to be true. Like, I think there's a lot of fraudulent stuff. And then there's also a ton of macro risk with economic tensions between China and the US because they source so much of their supply from there. So
yeah, they seem to be trying to grow out of just China, but that still seems like a low light right now.
It's hard. I mean, that lowers the customer value prop, doesn't it? If you can't source cheaper supply.
That's true. And it really, hurts that delivery time. 22 days delivery is not what people are looking for anymore.
They saw 414% year over year growth in Wish Express, which is less than 5 day delivery.
Yeah, improving that. If they continue to improve that, that's better than not.
And I think a lot of that has to do with having Wish local stores, I imagine.
Yeah, that's probably true. All right, I'll hit mine. Highlights, the S&M spend is improving, but I'll talk about that at my lowlights too. It's high. Strong industry tailwind. I guess you guys didn't mention that. There's room for a lot of winners. Just because Amazon's in there, just because eBay and Walmart are in there and Target doesn't mean that there can't be a small company that's doing, say, $5 billion in revenue sometime down the line. I think it is a unique value proposition that is different than a lot of the other Western retailers like Amazon. They're kind of saying like, yeah, this stuff could be junk, but it's really like a giant garage sale, which has its own value proposition. You're not going like, okay, you go on Wish, theoretically, I guess is kind of what their value proposition is supposed to be, is you go on there to browse and find things you didn't know you really wanted. It's kind of just a splurge purchase for $10, kind of like you do at a garage sale. But Amazon, you go there with the intent, searching for something. You already know what it is. You're hopefully on and off in 3 minutes. So totally different. Lowlights is the last 12-month buyers stagnating since 2018. They had, I think, 64 million last 12-month buyers in 2018. And, now Ryan gave that number at 61. I think that's just a giant red flag. When you couple that with the high S&M spend, if you're spending 60% of your revenue on sales and marketing or 108% of your gross profit on sales and marketing, and you're not growing customers,
but they're growing. The customers are down because of the emerging market stuff, but the value, the 75% year over year revenue growth from active customers, that's where I think the marketing spend is going. If you can generate that revenue from your existing customers, does it really matter? I would rather them peel it back in the emerging markets.
All I'm looking for is is S&M spend as a percentage of revenue to come down and customers to grow. That's all I'm looking for, because what I'm seeing is if your customer count is stagnating and sales and marketing spend is this high, it tells me that you're not, that feels unsustainable to me, because maybe they can peel back S&M spend and customers won't tank. But if you're advertising this much and customers aren't growing, that's tough for me. And then ad feels gimmicky, but maybe that's part of the deal. It threw me 4 50% off codes before I was going to buy an item. I just think that's a lot. Maybe that's fine. But I don't know. For me, it kind of threw me off, and I don't think I'm ever going to open it again.
You might not be the target customer.
Yeah. And if I'm not target customer, that's fine. Doesn't mean Wish can't succeed without me.
Yeah. All right. More or less interested, Brad?
I'm going to go more interested. I do need to see a couple quarters of continued growth and continued movement towards profitability, and I would like to see that buyer growth return. I'm talking about when that happening when we get beyond COVID-19. This probably didn't get as large of a boost as some of the other digitally native marketplaces. But I mean, when garage sales come back, when thrift shopping comes back, there's going to be more competition, and I'd like to see how they handle that return of competition. So more interested, but going to take a wait and see approach.
Yeah, Ryan?
More interested. I think Peter is brilliant. He's well respected, especially in kind of the tech community. I also think Jackie just deciding to come on is sort of a vote of confidence, especially for shareholders. If they're mildly successful, it's a cheap multiple, for sure. And EBITDA margins have improved constantly, and they're expected to improve sequentially next quarter. I think there's a world in where they're profitable. I'm going to go more interested for now. Obviously, there are some lowlights, I guess you could say. The sales and marketing spend is concerning, and the fraudulent stuff, I guess, is more of a feature than a bug. But
I wouldn't call it fraudulent. Maybe counterfeit is technically fraudulent, but it's kind of its own. It's a lot of counterfeits. People were complaining about it online, like it's all counterfeit.
But it's mutually agreed upon counterfeit items.
I guess.
From a buyer
if you
and
want
seller.
Yeah. But the thing is, like, when you do that, you're giving up. Nike's not going on here. I mean, Nike didn't even partner with Amazon. They're not going on here, or at least they're not going to be legit on here.
Definitely. Yeah, no.
So, I mean,
well, there might be Nike products.
There's Nike logos, but no Nike products. Yeah, they're probably very upset. I'm more interested, and I'd say just like you guys. I mean, it's almost strictly because of the valuation. I mean, 3 times gross profit, very cheap for what they're putting up on their growth rate. Margins are really tanking on the gross margin side, and there's going to be this share dilution coming down the line. So you kind of got to factor that into play. And there are a ton of lowlights with the business model, but you're not getting the number one horse, but you're getting some pretty good odds. So that's something to consider. Definitely going on my watch list, Ryan.
Yeah, I'd also add the customer spend. So the customers that are staying are spending 75% more. That's good. And the orders, whatever it was, percentage of orders that are above $20, up 54%. You like to see that because the economics are better that way too.
Yeah. Yes, for sure. I think there could be some operating leverage as they scale, but without owning the network, without owning the logistics stuff,
not as much.
Maybe not. I don't know. There's a lot of lowlights here, but if they can execute and turn things around, I mean, the valuation is pretty compelling.
There could be returns.
Yeah, I don't know. I'm on the fence. A lot of things to like, not a lot of things not to like. All right, let's wrap things up. We have the stock for next week. Brad, what is your choice going to be?
Yeah, and I looked through the Chit Chat Money library, and I did not see this stock pop up. But if I missed it and it did, then just tell me and I'll pick a new one. But let's do UiPath if we have not done that one yet.
I don't think
we have not. I've heard that one thrown around a lot, so it should be an exciting one. Software, B2B software, no.
Yeah, we'll try to figure out what it does.
Yeah.
That's a task for next
They're
week.
using a lot of AI, machine learning, so it's obviously a buy.
Flywheels. There's a lot of flywheels.
So many flywheels. All right, that's going to do it for this episode. Thank you all for listening. Remember, we are not financial advisors, so anything we say on the show is not formal advice or recommendation. Ryan and I are general partners at Arch Capital. Arch Capital clients may hold securities discussed in this podcast. Again, thank you all for listening. We'll see you next time.